for the most part, this kind of just came right out of my brain really fast. Two things that means. One, I know what to look for. And two, if I spent more time, this would be 3 times as big. So by looking at this, don't expect that we're going to be able to cover every single thing for passive investment today. But these are some big things that can help you if you're going to be a passive investor, or if you're active and you want to know what passive investors are looking for. These are the main things. It boils down to 3 different big parts. The 3 things that you want to know are happening is that you have a good team behind the asset. The second thing is that it is in a good, strong market. And the third is that the deal itself is sound. So what we're really talking about as passive investors today is putting your money completely hands off into a property that you might be making 14% returns, 16% returns, or maybe a little bit higher. And so we're not really talking about passively lending your money on a fix and flip. We're talking about how do you vet a syndication deal. And a syndication just means a lot of us are going to get together. A couple of us are going to run the property and operate the property. And a lot of other people are going to passively invest a medium amount of money, somewhere between $25,000 per person up to maybe a couple of $100,000 per person. And so you take a lot of people that are putting like 50 or 100 grand into a property, and then you have some operators who run and manage that property to make sure that it performs appropriately in order to give the passive investors a good return, which is usually a 14, 15, 16% return. And that 14, 15, 16% return really comes with, on the front end, they're getting some cash flow, usually 6 to 8% as you are operating the deal. The rest of that 16% return gets paid when you either refinance the property and you have money to pay them, or when you sell the property and then you're able to give the money to the passive investors. Does anyone have a question about syndication before we kind of break down the parts? You can ask.
Not sure what to ask.
Okay.
And if anybody's watching live on Facebook, go ahead and type it in the comments section, and I will read it for Adam so that he can answer it, so he can participate.
We're live on Facebook?
Yes, we are.
What's up, Facebook? Yeah, I went to Los Angeles, and somebody who could barely speak English comes up to me, and they're like, "You're the one," in the very strong accent, "you're the one who always says, 'What's up, Facebook?'" I guess I got to change my tune, because even if you can't understand me, you still know exactly what I say. All right, so let's talk about a few things that you're going to look for in a team. Cool? All right, number 1, financial stability. So what I mean by that is you want to understand, does this operating team have capital coming in? Are they financially sound on their own before you start putting your money with them, because you don't want them to need to rob Peter to pay Paul, because you're Peter. Cool? All right, the next thing is criminal background checks. So it's very important, if you're running the deal, that you actually spend the time and money, and it's usually only like $30, to do a background check on not just one of the people in the operating team. If you're passively investing in my deal, you want to do a background check on Adam Adams and a few other people that are also on the team. Does that make sense? Any team that you're doing, what are you looking for? Number 1, you want to make sure that they don't have any SEC violations. What's the SEC? What is that?
Security Exchange Commission.
And what would an SEC violation be?
Raising money illegally.
Raising money illegally. Perfect. So you want to make sure that they have never done that before. Another thing that you want to make sure is that they don't owe a whole bunch of people money. Another thing that you want to make sure is that they have a decent credit and not a whole bunch of things that they've done badly in the past. So that'll help you to understand if you're safe and protected. Is this one on the screen went black? Do you know?
Oh, I
Check.
don't know. My IT guy should probably come look into that.
All right, and so the fourth thing is understanding what their track record is. Okay, so there's a lot of people that want to get into syndication today, and if they're doing it and they don't have a track record at all, if they've never done anything, your money is probably not going to be as safe as if they have a strong track record, if they've been doing a lot of deals. Does that make sense? The next thing is niche, and most people don't consider the niche. I suggest to you that you focus, if you're going to be a passive investor, that you focus on a team that is only focused on either one market or one strategy. If they're saying to you, oh yeah, we do anything in the whole world, anything from 5 units and up, and you say, what's your biggest? And they're like, oh, I don't care, 1,200 units, I'll still buy it. What's the smallest? Oh, I don't care, 3 units, 5 units, 10 units, whatever. What asset class are you focused on between A class, B class, C class, and D class, and F? And they're like, oh, whatever, we can do the D's just fine, we can do the A's just fine. If somebody's trying to give you this kind of information, and they're not focused on in 1 or 2 markets, 1 or 2 property deal structuring, if they're not focused, you're probably going to see that they suck at what they're doing. It just makes it so that your money is not safe. So the more niched that your sponsor, which means the general partner, the operator, the more niched down that they can be, the safer your money probably is.
I just had a quick question. When you were just talking about make sure you're finding a team that focuses on like 1 or 2 markets. But you mean like, or do you mean, because I know that your company specifically has focused on other markets in the past,
Yep.
but then has changed focus, and that's not a red flag because you've already got your asset there, it's performing, and then now you're moving on to another emerging market?
Yeah, I think, so I think what she's asking is, our company, I have property in 5 states right now, and currently today we're focused on only buying in Oklahoma City. So the question is it risky to invest with you because you have assets all over the place? Or is it good to invest with you because now you're focused on one state or one city only? I would say in general, and I'm not trying to say that I'm a risk, I would say in general, if somebody has assets all over the place and now they're focused on one, you're going to want to ask more questions to try to understand what their capacity is for the deals that they have. It got difficult for us to run deals in that many cities, so I've been doing 2 things. Number 1, I've been selling off as much of my smaller properties as possible, and number 2, I have brought together a bigger team. So you'll want to do your own due diligence, especially on me. What I'm trying to say is, because we have now 2 asset managers, it's probably easier for my team to run deals in multiple places than some teams that don't have 12 people on their team and 2 of them are asset managers. If they're a smaller team, and we'll get into that later, where everybody's wearing a lot of hats and they can't segregate their workload and focus on one thing and do it right, I think that that's more risky than with what we're doing, where we have 2 asset managers, 4 people on acquisitions, 2 people on social media, right? So still, it can be a concern even on a team like ours, where you want to have a conversation to try to understand, like, what's happening with this property, what's happening with this property, what's happening with this property. And if we can't eloquently explain how those are performing, why they're performing, and what we'll talk about a little bit later is putting you in touch with our own passive investors and having them tell you how it is to be in our deal, then you'll probably want to feel like it's a bigger risk. But we'll go into a lot of those other details.
Once you feel that the market in Oklahoma City is no longer where you want to invest, would it be riskier to go into a new market with you in your first deal when you're switching markets in maybe a few years?
Yes.
Okay.
It would, and the way that we are going to make it less risky is by partnering with somebody that already has deals and knows the property management companies and has connections there and has already been doing. So when you have somebody who's switching focus, because every market is cyclical, it will start to rise, and then it's time to kind of sell, and then it's time to buy, and then it's time to sell. The biggest thing that you want to know is either their personal experience in that area or their partner's experience, because at least with my team, we would not do this alone. We wouldn't go to a brand new market without having somebody on our team that was there. And I'm hoping that you as a passive investor make absolute certain that you're not going to put your money with a team that is going in completely blind into a brand new market without an experienced person. So deal track record, the niche, reputation, and referrals is the next thing that I wanted to discuss. If you do your own due diligence on an operator, you will understand if they have good references. You can ask them for their passive investors to talk with you. You can look them up on Google and actually find out if they have good reviews or bad reviews. If they're not findable on Google, that could be a bad thing. I'm not specifically saying just because somebody has a podcast that they're automatically safe. I'm not saying that. But I am saying people like me that we just hit another record. I think we have 34,000 downloads. 34,000 this month. Once you are in the limelight, it's difficult to stay solid in front of the eyes of everybody. If I made a mistake, it would blow up faster than if probably you made a mistake. Does that make sense? So it doesn't necessarily mean that everyone that has a podcast is automatically a safe bet, but it will help you to understand as you read the reviews for that podcast, as you talk to other listeners, as you talk to other passive investors, and vet them and try to understand what they're doing and how they're doing it. You'll start to be able to feel better if they're a good person to put your money with. Does that make sense?
Like Clayton Morris?
Once he went on and got into some stuff, it's on Facebook every single day. Like, if you ever follow him, and I'm not saying anything good or bad, and you've got me on Facebook Live.
Put you on the spot, sorry.
Once that happens, I've heard from hundreds of people to stay away, to stay away, to stay away. So same thing, if a podcaster or Fox Television or whatever person makes a mistake, you should be able to find out about that. The person that she just mentioned is very Googleable right now, and most of it's negative.
What should we do?
That's for you to Google the name. And we will stick on to what we're looking
Back
for.
to the paper, back to the paper.
Back to the paper, guys. All right, so here's another huge thing that we touched base on, but I'd really like to focus on this. Another piece of the team, look at the last line there, teammates and roles, the roles within the team. Does anyone see the small print there? Are they wearing too many hats? If they're a newer company that's just starting to get in, you might have 1 or 2 or 3 people in the company, which means that they are all stressed out. I have 12 people on my team, and we're still super busy. I can't imagine trying to do that with just 3 people. So if they're wearing too many hats, balls will get dropped. Also, as far as understanding their teammates, their roles, who's sponsoring, who's signing on the loan, ask these types of questions. You'll also want to ask, who is your attorney? So normally you'll have multiple attorneys. You might have a contract attorney, you might have a real estate attorney, and then you'll have a securities attorney. that are all three helping to make sure that everything's safe. But if you go and talk to a operator and prior to you investing with them, and they can't tell you the name of their attorney, it's probably not a good bet for you. Does that make sense? All right, the next thing is the property management manager. Out of all of the teammates out there, the property management company is one of the biggest things that matter. If they can't tell you who is managing the property, why they picked them against everybody else, then you're probably not investing with a company that's going to keep your money safe. The most important thing to my team is who do we have as a property manager? How did we vet them? How do they stand up against the competition? What is the property manager's 5-star, 4-star, 3-star ratings on Google? So you're going to want to look at all of these things prior to investing. Understand who is the attorney, understand who is the property management company, and do your own due diligence on that. Does anyone have any questions about the team before we move into the market?
And again, if anybody watching on Facebook has a question, just type it in the box and we'll read it for Adam.
Awesome.
You just go through and do people's name like yours? Or
Yeah.
Is there a better way to do
That's a-
business bureau?
One thing that we do, so sometimes we partner with other teams that are already out there. And one thing that we make sure that we do every time we partner with a new team that we haven't partnered with before is we actually tell them that we're going to do a background check. And I don't want to have to collect all of their social security numbers myself. So all we do is we use a service. My partner DJ is the one who knows the name of that service, and he's the one who operates it. But I think it only costs us like $20. We pay for it. It's worth it to do that on 5 different people. But all you do is you would email me and my 5 partners, and you would say, I need you to go into this service and fill this out. It only takes a few minutes. You'll say that you'll pay for it, and then it pulls up or propagates our information very, very quickly. You understand our whole background, and it's cheap, fairly cheap, $100 to do it on 5 people, something like that.
Adam, real quick, so you mentioned the teammates and the roles, the property management company, which
Yeah.
is usually for the deal, right? Because it could be different with a different deal in
Yeah.
the city or elsewhere. Do you have a belief of should there be one person on that team that's kind of the leader of that team? Meaning, like, should there be like a strong person who's kind of overseeing everything, even though it might be the asset manager, or he might have a particular role? Or do you feel like as long as there's just competence in all the roles of experience, that's enough? Or do you think there should be
In
like
this property management company,
on the syndication team, like a lead operator, a lead GP, whatever you want to call it, on that team? Is that something that people should look for? Does it matter?
repeat the question, because on the first half that you were saying, I was thinking that you were talking about the property management
So
company.
take the property management company out. You got the asset manager, you got the underwriters, you got all that. Should a wise passive investor look for one lead person on that team, like the CEO of the team, the president of the team, like
In order to do a background check?
in order to feel confident the team has leadership, right?
Okay. Good question. So I think what you're asking is, should somebody on the team be the leader of the team?
More or less, yeah. Even though there's defined roles, everyone's got their part. Should there be like one guy or gal that kind of oversees all of it, just restraining the team?
It's not me. It's DJ. I'm just the face. DJ's the smart guy that pulls the strings. Yeah, I think it's probably team specific. I mean, there's going to be a lot of vetting and a lot of trying to understand the team, and I think that you could probably work with 3 leaders, with one person leading the acquisitions, one person leading the property management, the asset management, and maybe one person leading the investor relations or the money raising. I feel like that would be a fine way to do it. We have a CEO. He doesn't necessarily oversee me, and I don't necessarily oversee him. He focuses on his role, I focus on my role, and then we have an acquisitions guy that focuses on his role and manages the acquisition team. And in my feeling, personally, I feel like that's a strong team. but I mean, you'll probably want to ask. I think it's a valid point. It didn't come up in my mind before this presentation.
We've got a question from Christopher.
What's up, Christopher?
He wants to know if you've ever had to let a property manager go, how
Yes.
you smoothed over the difficulties with the limited partners or the financial side, and a second question, what specific things you're looking for that set property managers apart, proactive versus reactive.
Okay. First off, I want to answer the second one first.
Okay.
There's things that set property managers apart. Absolutely, 100%. Things that set a property management company apart is their reviews and their referrals. So before you work with a property management company, you want to see what's happening online. There's always going to be negative reviews for every company. And the second one is their referrals. So you're going to want to talk to people that have worked with that property management company before. If you are focused heavily in a market, then you're going to be able to usually pick one property management company. And by the way, these aren't going to be small property management companies. These are going to be larger property management companies that already have 6,000, 10,000, or 20,000 doors that they manage. And 6, 10, and 20,000's not a whole bunch when you're talking about multifamily. That's 100 units or 200 units. But you want to make sure that they've been doing that and that's their focus. You don't want a property manager who just has like a few dozen or 300 single family houses to manage your 200 unit apartment community, because they're completely different. So that's one thing. And then the second thing is, have we ever needed to let a property management company go? And not specifically a company, but on a smaller property, which I don't recommend that you do small properties anyway. On a smaller property that we purchased, they had a property manager that was on staff prior to us purchasing the property. A lot of P's. Prior to purchasing the property, there was already a property manager in place, and we thought that it would be a great idea to not change anything. So we left this property manager managing the property, and it went downhill fast. It went downhill so much that 3 quarters in a row we could not pay our passive investors. How many P's are there? This is like what's that penguin show, that penguin movie that I watch with my kids, Mr. Popper's Penguins? A lot of P's. Anyway, the point is, another P. The point is that we did not want to fire the property manager, because that hurt our feelings, and she said that she was going to do better, and we're like, cool, well, if you're going to do better, then why would I need to fire you? So we just left her in, and it was bad, and we're like, hey, these are things that need to be worked on, and it was very difficult for us to fire somebody. We didn't want to, and it would take a lot of work to vet another company, to fly out there and make sure that we're using another company. And as we figured all of this out, we realized that she was getting paid less than almost any other property management company. So I think she was taking don't quote me, she was taking 4% of the rents. And when it became time to renew somebody, there was no fee for a renewal. When it became time to put a new person in, there was no fee for a lease up. And when we had to fire her and finally fired her and brought in a different property management company, they started taking 10% of the rents, not 4. They started doing half of a month's rent to renew, and they took up a full month's rent to place a new tenant for a lease up. And so what had happened was we used all of the numbers for the first person in our first prior underwriting, and now we have our expenses are more than double for property management, and it was very difficult. We also found that either she was not very honest or she was kind of dumb. And rather than, when you have a water leak, rather than cutting out the drywall that's moldy, fixing the water behind the wall, making sure it doesn't leak anymore, and then replacing the wet, moldy drywall for a new sheet of dry, good drywall, painting it, and you're good to go, rather than doing the smart thing. I don't know if she noticed it and told the contractors what to do, or if she had no clue, wasn't managing them appropriately, but instead the water leak stayed, the mold stayed, and we had somebody put drywall over top of wet wall and just paint that. So it was a Band-Aid. You couldn't see the bruise, you couldn't see the scratch anymore. But ultimately it cost us more money because we had to pay the first time and then we had to redo it. So the point is, yes, we've had to fire somebody, and we've learned a lot from doing that. And I would love to just sit down with anybody who's going into the same thing and try to help them to avoid many of the mistakes that we made on our very first syndication. We were unable to pay our passive investors. Why is there so many P's? We were unable to pay out any distributions for 3 quarters in a row, and some of the passive investors needed or planned on making 8% annualized return on cash flow before we sold. And hopefully that answers that question. Yes, we have, and don't hire the same person that was in place unless you've vetted them before you had to buy the property. All right, so let's talk about the market and the sub-market. MSA means Metropolitan Statistical Area. And what is an MSA? Who can help me figure out what is MSA? Not just what does it mean, but what is it? Is it a city? Is it a county? Is it
Area.
what kind?
It can include multiple cities. It's a designated area by the government places in a certain place.
So if you're looking at Salt Lake, what is the MSA of Salt Lake? We're here in Salt Lake today. What's Salt Lake's MSA? Is it Salt Lake City? Is it Salt Lake County? What would you think?
Davis,
Is it
Salt
all
Lake,
the
and Utah.
suburbs around within 30 minutes? What is the MSA?
Davis, Salt Lake, and Utah counties.
Davis, Salt Lake, Utah. Does that make sense? So it's anything that people naturally are working in Salt Lake, and there's no big gaps between the two things, right? So perfect. Davis County, Salt Lake County, Utah County, that's going to be an MSA for Salt Lake. So if somebody was buying in Layton or Farmington, that would be, you were in the MSA of Salt Lake, but you weren't technically in the city of Salt Lake. Does that make sense? All right, but then we need to look at submarkets, and a submarket doesn't just mean Kaysville. It means maybe West Kaysville. It might mean this small neighborhood, Draper, et cetera, et cetera. Does that make sense? Those are like the submarkets, and that can go down to just as close as the street. And what you want to look for, and I've already given you a lot of these answers, what you want to look for when selecting an MSA or when investing passively with a company that is choosing an MSA, I want you to never, ever, 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 ever go beneath 150,000. So, does that mean you can or cannot invest your money in Layton, Utah? Layton, Utah might have 65,000 people. Can you invest your money in Layton or not? Yes. But why? Because the Salt Lake MSA has probably a few million. Does that make sense? Okay. All right, so the next part is population growth. What you want to look for is an area that has been growing 1% year over year for the last several years in a row, and the reports show that they will continue to grow in population by 1% year over year for the next few years. If you are looking at a market that isn't planning on growing for the next few years, what you're going to find is that you cannot hit pro forma. Pro forma means what you expect to have happen over the next few years. If what you expect to have happen over the next few years doesn't line up with population growth, then you're going to be in a bad area and you will likely lose some money. You won't hit the pro forma. You won't do as well as you could if you were growing 1% year over year for the next few years. Does that make sense? Okay. The next one is job diversification, and the way that we look at it is you look at all of the industries that are in the area, and you want to have many, many, many types of industries. Throw out some ideas. What are some industries out there that you can, it's frozen. What are some industries out there?
Insurance.
Insurance, okay. What else? Tech? Aerospace? Say it again. Good. Mining?
Medical, university.
Medical? Education? Government? Agriculture?
That's what I said.
Oil and gas? So if you go to an area that has 22% oil and gas, I'm not talking about one company, just Flying J. I'm not talking about one company. I'm talking about an entire industry of companies within an area that's either government jobs, educational jobs, aerospace jobs, car manufacturers, oil and gas. If you look at one and it has more than 20% of the job force, that's an area that I suggest you skip. Because Detroit, I believe, when vehicles stopped being made and things got rough, Detroit became a completely depressed area because I don't know, they were probably like 50% dependent on this one thing. So if you can find something where no one thing is more than 20%, that's a good way to say that you're safe. And the smallest itty bitty pieces where it's so diverse that it can be 10% at no more than 10% each, that's an even stronger area in my mind when it comes to job diversification. The next thing is rental rates. What you'll see is with rental rates from Neil Bawa, I told you guys about the Creative Real Estate Podcast, episode 242. If you care at all about understanding market analysis, you need to listen to 242. One of the interesting things on my podcast that Neil Bawa said is something that will stick with me forever, and I hope it sticks with you forever. You want the rents of the property you're buying to be no less than $700 per door. Neil Bawa says if it goes down to $600 per door, which a lot of very small areas, they're paying $300 a door, $500 a door, $600 a door. If it falls below $700, you are 10 times less likely to hit pro forma, to do what you want to do. And there's a lot of reasons why. You'll get those reasons why on the podcast, episode 242 of the Creative Real Estate Podcast. I need to move it through, so go ahead and listen to that. You'll get a lot of value, I promise. And you don't want it to go up above $1,100 per door. Yeah.
Sorry. That's so like 700 for like a 1-bedroom, 1-bath, right? 1,100. It could be different for just based on what your mix is.
It could be it could change based on unit mix, but the specifics would be like a 2 or 3 bedroom for under 700. You would never want to do it. In general, depending on the market, and it's in general, doesn't mean take it forever and never invest in single bedroom houses, 1-bedroom apartments. Don't not do that, but if you do that, make sure that you understand what the market is for the 1-bedrooms before you buy it, because a lot of times they're harder to fill than a 2 or a 3-bedroom. regardless of that, I'm talking about a 2 or a 3 bedroom.
Okay.
You never want it to be under 700. You might not want to buy 1 bedrooms anyways. And then you don't want it to be above 1,100 per door, because if it goes above 1,100, you're less likely to hit pro forma. And part of that reason is once you're in an area where the 1,100, when you're above 1,100, one of the things that can happen is that if you can afford that rent, you could also afford to buy a house. So you're less likely to be renting in the area. And this changes a little bit based on market. Please don't ever go under 700, ever. But if you're in Salt Lake City and the rents are all 1,600 and it's in a C class, B class neighborhood, you might be able to push the 1,100 a little bit. Does that make sense? All right, so the next thing is on the median income. What you want is it to not be anywhere outside of the 3 times or 4 times the asking rents. Once you have median income more than 4 times the monthly rent, they're less likely to rent and more likely to buy. If it's below 30, if it's below 3 times, then they are unable to pay and they're more likely to be evicted, and tenant turnover is one of the most expensive things that you can have. So remember that, to always pay attention whether you're running the show or you're passively investing with somebody who's running the show. Ask what the rents are. If it's outside of this, you already probably don't want to be there. And once you understand that it is between 700 and 1,100, you want to find out what is the median income in that area, in that neighborhood, in that sub-market. What's the median income? And if you see that the rents are 1,000 and the median income is 60,000 or 5,000 per month, you're at 5 times the rent, which means that you're in a bad area, not a good area, because they're less likely to stay as renters, because they're probably just getting in for a short amount of time just so that they can buy a house as soon as possible. Does that make sense? Okay. Here's some other questions to ask. Job growth. So not just job diversification, not just population growth, but are jobs moving into the area? If jobs are moving into the area, you're probably going to be in a safe spot. Wage growth. That means, are the wages for the jobs increasing as we go, or are the wages for the jobs staying stagnant or dropping? If the wages are increasing and the jobs are increasing and the population is increasing, you're going to be in a safer area to be able to invest your money passively. The next thing is median home prices. You want to understand what is the median home price and reverse engineer the median income that we already discussed and find out, is it better to be a renter in this area or better to be a buyer in this area? So make sure that you understand the median home price, and also make sure that the median home prices have been going up and will continue to go up. Does that make sense? All right, cost of living. One of the big things that we did when we found Oklahoma City, besides all of the things that I've already shared with you, one of the things that not everybody does is understand how affordable it is to live in this area. The more affordable that it is to live in the area, the more likely that the area can come up. If the cost of living is already incredibly difficult, it's less likely that the area can come up. Does that make sense? Okay. The next thing you want to understand, and a lot of syndicators do not do this, and this is one of my huge pet peeves, is they pick school districts that are crappy. I would have said something else, but we're on Facebook Live. They pick school districts that are terrible. They see a lot of other metrics that seem to make sense to them, like cash flow, which is not on here. And they care less about, is this market having good schools? Because the better schools show the least crime and show the best ability to grow. And the worst schools show the best ability to shrink. And the next one is crime rates. And when you, because I know you're going to do it, when you listen to episode 242 and go into more detail on the crime, what you're going to learn in detail is that there's a certain number that you want for crime, and you'll know every way that you need to do to find that number, but you'll also be able to find out, is the crime getting better or worse? The detail that I want to share about that is, and write it down, if the crime gets better very, very quickly, it's a bad thing. It means that the market that they're in did something like lock a whole bunch of people up or change their laws on what crime is. And it changed overnight to be at an incredible rate. And when they get out of jail, it's going to jump back up. Or it's still happening, but you can't see it because they changed the way that they mark crime. So what you want to see is a slow, continuous decrease in crime. Does that make sense? All right. Absorption rate. Somebody tell me what that is. I feel like I've been talking too much. What's absorption rate?
Supply is not outpacing demand. Supply of units, so developers aren't developing too much for what the demand is in the market.
Perfect. And
Can you repeat that?
yes, I will. So he's saying that absorption rate is basically supply and demand. Units coming on board and people moving into the units. People being able to absorb the units that have been getting built. So you want to look at absorption rate, and as I look at absorption rate, and I look at Oklahoma City, which we love, and Tulsa, which we definitely do not love, even though they're not far apart. In Oklahoma City, there's not a whole bunch of properties coming up compared to how many people are moving here over the next 3 to 5 years. But if we look at Tulsa, they have been building a lot compared to nobody moving there for the last 10 or the next 5. It's been a stagnant market for the last 10 and the next 5, meaning as they continue to build, the CoStar report will show you that right now we're at 6% vacancy, and by 2022 they're going to be at 12% vacancy. The issue with the syndicator that is showing you a deal in Tulsa right now is that, and it's unfortunate, but what's going to happen is they're going to show you on their pro forma that they're going from 8% vacancy to 4% vacancy over the next 3 years, and that's where they're going to exit. But if you really look at it, right now they're at 8% vacancy when it's a 6% vacancy market, and in 2022 they're thinking that they want to be at a 4% vacancy when it's a 12% vacancy market. The big issue is that they've showed you numbers that can lie. They've showed you numbers that make you expect, oh good, they're going to improve the property. But if you didn't do your due diligence on the market, then the problem is going to be that you're going to lose money, because they're actually having more vacancy, which means less income, which means a smaller NOI, net operating income, which is the way that properties are calculated based on two things: the net operating income, how much money they make after expenses, versus the cap rate in the area. And so right now, again in Tulsa, if the cap rate is currently at an 8 and we go to really bad vacancies, 12%, the cap rate itself is probably going to be 9 or 10, which means cap rate means a higher cap means a lower value, a lower cap means a higher value. Does that make sense? So, and this is what bothers me about many syndicators that you need to be careful before you invest with them, is that they will show you a couple of things. They will show you that we're buying it at an 8.5 cap, and because they're buying it at a 7 cap, but because they're being conservative, they're going to sell it at a 7.5 cap, buying at a 7, selling at a 7.5 because they're being conservative. They're really buying at a 7 when it should be an 8, and they're really selling at a 9 when they think that they're going to be selling at a 7.5, which means, again, you lose a crazy amount of money. If you didn't follow me, all good. There's a lot of new terms there. If you didn't follow me, just let's talk about that after, because it gets into big detail.
Whose responsibility is it? Because most passive investors don't want to go to CoStar and vet all of these terms here. When the operator gives them these things and you ask these questions, how is your average passive investor going to verify that information if they don't have access to the same tools?
Well, me personally, I actually don't think that a passive investor should be a passive investor in something that they don't understand. So she's asking, like, if the passive investor doesn't already know all this stuff that I just told you, should they? Are they going to blindly trust somebody, or should they do their own work, or should they just not invest? I would say definitely don't blindly trust. Learn about it, do the own work, and then if you understand what's happening, then you invest. In our deals, I don't want passive investors that have no clue what's going on, what the risks are, what can happen. I would prefer to have passive investors who get this stuff, right? And if you're listening on Facebook or you're in the audience right now, please learn this before you go and invest passively, because this is going to make or break you. And just because I'm the one up here teaching it doesn't mean you automatically can trust me. Does that make sense?
Yes.
Other people are going to teach it, doesn't mean you can automatically trust them. Figure it out, learn it, and when you're at a place where you know how to do this due diligence, then you're in a place where you can put 50, 100, or 200,000 into those deals. It's very, very, very important. So, any questions before we move on to the deal?
So are you taking a look at demographics of the area or no?
By demographics, do you mean like race,
Yeah.
gender?
Race, gender, age.
You're live.
Do we take a look at it? Of course. The most important parts of what makes a good deal is on this paper already. So we want to understand it. We want to know it. The part that's not here is of the demographics that is more important than race and gender is are they single? Are they married? What kind of jobs do they have? Because when you understand it, if the population and the jobs that are there, if they're single, if they're married, if they have certain jobs and certain incomes, you just really want to know, does your property support families because there's a need for families, which is something that we're going to get into on the next part, where we're really specifically talking about the feasibility of the property, right? So in the next thing, we're talking about property, and that's where I start to consider the demographics. But I don't really, we look at it, we understand what it is, but they don't affect as much as, do I have 3-bedroom, is my whole entire property 3 bedrooms, and the whole entire market is single adults with no kids that don't want a 3-bedroom, because if that's happening, then I've bought the wrong property, and vice versa. But I can't, you can look at it, people look at it, we look at it, but it hasn't yet affected like numbers. All right, so the property, the deal. What we're talking about is, here's the 4 big things: property due diligence, financial due diligence, the business plan or feasibility, which we just mentioned, and then we talk about the fees or the fees that the operator takes, or the structure of the deal. How much of the deal do you get, and how much of the deal does the operator get. Okay, so the 4 things again: property due diligence, the physical due diligence, financial due diligence, the numbers, the business plan or feasibility of the business plan, and then finally, how is the deal structured? How are the splits happening? And so we'll get into these 4 things right now. The first thing is the property due diligence. Here's the 3 main things under doing your due diligence on the property before you invest. Number 1 is the systems of the property. Number 2 is the interior of the property. And number 3 is the exterior of the property. The systems, the interior, and the exterior. Here's some parts that are considered systems. The boiler and the chiller, which really means the heater and the air conditioners. Okay, the boiler, which is a heater for the entire building. The chiller is the AC, but for the entire building. These are major mechanical systems that if they break, will shut down your whole property for some time and going to cost you tens of thousands or hundreds of thousands to fix or replace. So you want to check the systems, the boiler, the chiller, the HVAC, which is the furnaces. You want to check the roof, because that's a super big expense. You want to check the plumbing. What kind of plumbing is it? How old is the plumbing? Is the plumbing leaking? And I should have put the sewer. Sewer should have been on here. I didn't write that down. The sewer, always do a sewer scope and make sure that your operator does a sewer scope, and make sure that you ask about that. Make sure that you ask about the roof. Make sure you ask what age are the HVACs. What age is the furnace? What age is the boiler? Does the boiler, the chiller, the furnaces, do they have permits? Does this all make sense so far? The next few things that are on there is the electrical. Is it copper wiring? Is it aluminum wiring? Does it have pigtails? What kind of boxes do they have? Are they old boxes? Are they new boxes for the breakers? And then we will talk about the foundation of the property, which is a big expense, the whole foundation of the property, and then the drainage, which includes the gutters and the landscaping. Okay, so what you want is you will have the roofs. You want to see if there's gutters. And most passive investors are not looking at this. Check the pictures, find out what's going on with the drainage, because if the landscaping has the drainage coming into the property, you're going to have issues. And that's hundreds of thousands of dollars just to make the landscaping do this and get the water away. So these are huge things, and they cost a ton of money. Systems. Next one is interior. You want to look at the rental comps, comparable rents. You want to look at what those other properties look like and how much money they're getting, and you want to look at what yours look like and what you would have to do to look like the competition. And then you will want to get bids from contractors to understand how much is it going to cost to do that to your property. I know it sounds crazy, but if you're a passive investor, I suggest you're doing each and every one of these things. All right, you want to understand how many down units there are. There are something called when the seller is going to show you how many vacancies there are. There is a difference between physical occupancy and financial occupancy, which means they might be living there but not paying. So it doesn't always just matter who's living in the property. You want to understand, are they paying? And we'll get into lease audits and a bunch of other stuff coming up. But just to kind of get through this, because I don't know how much time we have. How much time do we have?
About 15.
Okay, we have
start
to
flying.
blow through. We have to blow through this. Like, I'm not going to be able to give you all this detail in that amount of time. So just notice, you're looking for mold. You're looking for the laundry facilities. Do they have washer and dryer hookups? Do they have washer and dryers in each unit? Do they have the laundry facility out to the side? You want to talk about the exterior. Here's some things to look for. Is the lighting? Do they have lights for the night? Here's another one. Cameras. Are there camcorders to make sure that people want to be safe on the property, or they feel safe, or they're not going to do crime on the property? Is there gates? Is there a parking lot? How much does that parking lot cost if you need to resurface it? Siding, paint, the swimming pool, which is a big expense. If you buy a property in the winter, you want to understand if the swimming pool has cracks in it and all these kind of stuff. You've got to understand what it's going to cost for you to fix that pool, because sellers can just drain the pool and be hiding a problem because, oh yeah, it's already the fall, so we shut down the pool, and then you come into the spring and you fill up the water, and then the next day it's a foot down, and the day after that it's another foot down. You want to look at the clubhouse, you want to look at the cars in the parking lot. How old are the cars? How new are the cars? Do the cars have a valid registration on them? These are all huge, huge things that need to understand. During the day, are there no cars in the parking lot because everybody's working? Or during the day, is there a whole bunch of cars in the parking lot because nobody's working? There's so much to go through. I'm sorry that I thought that this was less detailed than when I was actually building. I started to build slides. Financial due diligence. If you look on this paper, you'll see all of the things that you need for your financial due diligence. If you don't understand what one of these are, feel free to ask. I'll share, but I'm going to skip it and let you just read it. The next thing is the business plan feasibility. So there's a difference between just having a business plan and if that business plan is feasible. The part that I really want to show, read all of these things. If you're on this side of the tracks, you're in a great neighborhood. If you're on this side of the freeway, you're in a great neighborhood. You're only a block away from that great neighborhood, but over here there's crime and everything else. So be very cautious not to just blindly trust an operator who shows you a comp that's 20 feet away that you can't get to because of the freeway anyway, and this is a terrible area and this is a phenomenal area. You want to look at ratio utility billing system. I think I put 2 B's. I didn't mean to. I just pronounced it, sounded it out. It's not supposed to have 2 B's. RUBS is, people are like, oh yeah, we're going to implement this thing called RUBS, which means we're going to give the tenants the bill now. But if it's not feasible, if you're the first one, the pioneer, if you're the only person in that area who's trying to implement RUBS, who's trying to make your tenants pay for everything, for all of the bills, the electrical, the plumbing, that kind of stuff. But if you're in an area where everyone's doing RUBS, and you put in your pro forma that you're also going to do it, that's good. But if you're in an area where it doesn't happen, and you are investing with a sponsor who says they're going to do RUBS, but you have learned that you can't do RUBS there anyways, then what you're going to find is that you've just avoided a bad thing, because as they try to be the pioneer in that area.
How do you know if they're doing RUBS in that area? Talk to property managers? And find
your
that
comps,
out?
property managers, and actually if you can tour the comps or talk to people that have toured the comps, or just double check with your operator who else is doing RUBS. And if they can't eloquently say, oh, this one, they're all doing it, this is the rents that they're getting, then you're probably investing with a bad sponsor. All right, so now we're just talking about the fee structure. Super important, and we will be done. What you're looking for is alignment of interest. What you're looking for as a passive investor is that you make money and your sponsor makes money at the same time. What you don't want is that your sponsor's always crushing it and making money, but you're left holding the bag if something bad happens. And here's the 4 things that you need to understand to know if you're getting into a situation as a passive investor where you have alignment with the sponsor. The first one is the sponsor also putting their own money in the deal? You'll notice that it doesn't necessarily mean it's a bad thing if they're not, but if they're not putting their own money in the deal, then you want to make sure that these other things are in alignment. And those 3 things, I guess there's 4, Those things are they taking an acquisition fee? That means, does the sponsor make money up front? And how much are they taking? You'll see that it's normal to take 1 to 5% up front for a sponsor, and 3% is fair. And you'll look at the management fee to see what they're making as you go, and you'll look at the disposition fee to see what they make automatically before they start doing splits. If they don't have their money in the deal, it's not necessarily a bad thing, but you want to make sure that they're not also taking a giant acquisition fee and taking a giant management fee and taking a disposition fee, because now they can't lose, but you can. Maybe they're not putting their own money in the deal, and that's okay, so long as they're taking a smaller acquisition fee. Maybe they're not taking a management fee as you go, and maybe they don't care about a disposition fee because they have their interests aligned with you. There's another one, is the ownership and revenue splits. The LP, which means the passive investor, the limited partner, the one that doesn't have anything on the hook except for the money that they put into it, typically you will see that they will get somewhere between 20% of the deal all the way to 90% of the deal. The limited partnerships. What I recommend is make sure I believe that you should get at least 50% of the deal and no higher than 80% of the deal as a passive investor, because you want your operator to make money. Because if they're not making money, then they don't care about the deal anymore. So you don't want them to give you 90% of the deal. And it's also not fair for them to only give you 20% of the deal. We usually do 70% of the deal. And we keep 30, and the passive investors get 70. So I hope this helps you in your next passive investment opportunity, whether you are passive or whether you're an active. And if y'all want this, email me.
I also just took a picture and posted it in the group.
Okay, awesome. All right, so I think we should go, once we're done with this, I think those of you who want to go and hang out and just sit down and chat, where it's not me talking at you and we could just hang out, I think we should do that. So.
I have a couple of questions on the financial due diligence.
Financial due diligence.
For those of us who struggle with that, because I'd say of all of these things, that's where I'm the weakest. What types of documents should we request, and what types of terms should we learn? Like you mentioned NOI and cap rate and some of those things, and I lose people when I try and explain those. So which of those things, which list of acronyms should we learn, and which documents should we learn how to read?
Well, so everything on here are the most important things, to be honest. So like, if you're a passive investor and you want to understand that you're doing the right due diligence based on the numbers, the money, you need to see a rent roll, and you want to see that the operator has somebody, a third party, that's doing an audit on the rent roll. They have to pay extra money to do an audit on the rent roll. So you want to be actually asking, who did the audit? Can I see the audit? That's the first thing. The second thing is something called a T12, a trailing 12. This is a P&L, which is a profit and loss for the last 12 months in a row. 12 years would be great, but you want to see what's happening for a year, or you can even do a T24 to see what happened this last May and the May before that. Are we above? Are we below? Does January to January match up with February to February? Where did it drop? Where did it raise? What is the typical time that it's coming down? What's the typical time that it's coming up? I mean, there's so much financial due diligence, and I don't even do the financial due diligence in my company. I have 4 other people that are focused on that. But you want to make sure that you actually look at their tax returns. So they're going to be filing taxes, and you want to prove that financials that they're giving you line up with what their CPA files, because they might be giving you fake financials and they really claim almost nothing. So, I mean, you want to look at that. You want to look at their bank statements. So you'll actually take the bank and you'll look at the P&Ls or the trailing 12, and you'll look to see what they said with their NOI or their net income was, and you'll compare it to the bank. What did they say came in? What did they say go out? Is it lining up? You want to look at the taxes. You want to understand what have they been paying in taxes, and when is the next assessment. In some cities, the tax assessors change the rate the day that you buy the property. In others, they change it once a year. In others, they change it every 2 years. So you want to understand the millage rate. You want to understand when do they assess the property taxes again, and how do they assess the property taxes. Is it based on the purchase price? And you do a bunch of calculations to figure out what it's going to be? Or is it based on it increasing 1% or 2% year over year? If you understand that, then you understand if you're going to be buying a property where all of a sudden the taxes change so much that you cannot hit your pro forma. It's like, I mean, we could spend days on this stuff. I'm trying to fly through it. Insurance policy. Look at their specific insurance policy. This is super, super important. Ask for a copy of it. Look to see what they have covered. And then when you're getting your own insurance policy, look to see if you can do the same thing. Look to see if you can match it. What you might find is they had an insurance policy which was $180,000 per year, and you can't find the same insurance policy for less than $280,000 a year, which is $100,000 based on a cap rate per year of a 5 cap. That's a $2 million difference, maybe $200,000. I think it's $2 million difference that you cannot pay. So you had an offer in for $12 million, but really it's only worth $10 million because you neglected to understand what's happening with the insurance. Because you might need flood insurance. You might need. I don't want to get weeded into this, but I get passionate and detailed about important things like this. That's one of the reasons why I skipped it. The last one. Oh, do they have an assumable? Do they have a loan that you might be able to assume? Go and grab the documents for the loan, the actual loan contract, and see if you're allowed to assume it. See what happens when you assume it. Do you pay a point? Do you pay 10 points the day that you try to assume it? If you understand all of those things before you assume the loan, then you're going to protect yourself as you do it. The next thing that you have to get is every service contract. So when you put in an offer, you're going to list all these things that I just told you, plus the service contracts, and you're going to say, my financial due diligence doesn't start until I have every one of these. The day that you have all of them and you can start looking at them is the day that you start doing your due diligence. And if they neglect to put one, you just let them know, I'm not starting this date until I have every single one of these. I need every service contract, which means you have laundry facility people that will manage your laundry for you, and they might have a 1-year contract, a 2-year contract, a 10-year contract. You also have pest control. You have all sorts of servicing companies like pest control and laundry that are going to maintain the property, maybe garbage. You want to look at the length of each and every single one of those, and you want to look, does it jump up year after year? Are they allowed to raise it up 5% per year? If so, you want to understand that before you close on a property. This stuff is like incredibly important. So anyways.
All right, thank you.
Yeah.
So I think it's important to say also that if you are an operator, these are the types of things that you should be teaching your passive investors, what these things mean and what they need to understand. If you're a passive investor, if your operator doesn't know this, and vice versa. So this goes, I think, both ways: how to be a responsible operator, how to educate your passive investors, and also as a passive investor to vet your own operator. So appreciate it's a really great, useful list. So.
That's the name of your company.
Blue Spruce.
Oh, and also Blue Spruce has this great conference coming up. Tell us more about that, Adam.
Yeah, well, in front of the live, or let's
Yeah.
turn off the live.
All right.
Let's turn off the live.
Hey, thanks
I got something
everybody.
just for these guys.
Everybody say bye to Facebook. If you guys want to come out to Red Rock Brewery, we're heading over there after this.
Red Rocks. Hey, I just went to a concert there.